this one. Okay. Yep. So yeah, what we will talk about. This webinar is mainly for the learn option trading from scratch. So we are offering a class from next month. This for actually 1 month class, and we'll talk about the class and we'll give you some idea actually how you can learn option trading and you can get benefit from here. This screen is little bit, let me see. Yeah, this screen is little bit messed up. Sorry, let me share this one here because this is not what you can see the screen, right? Or actually few of the text are a little bit messed up. Okay, yeah, that's fine. So maybe we can work around these things. So at first, the legal disclaimer that actually neither my company nor myself is a registered financial advisor. So we can't suggest what you should do or you should not do with your money. You will be totally responsible. If you want to follow our recipe or actually if you want to follow our plan. Investing is inherently risky. You might lose all of your capital in a stock market. So be careful about that one. You should definitely consult with a registered financial advisor before any type of investment. And we can just show you actually what works for us, but it might not work for you. So it's only your discretion actually you want to follow it or not. So what we will talk about in this webinar, at first a little bit about me, then what are the prerequisites if you want to start option trading, and then introduction to option trading, why option trading and not trading the stock market, and what are the current market condition and opportunities, where to start, and finally maybe some classes structure, schedule and cost, and maybe at the end some question and answer, but it will be interactive. So if you have any questions, you can actually feel free to jump on. Do you have any question before we start, or you can go ahead and start? Yeah, I think nobody has any question. So a little bit about me. So I'm a software engineer by profession. I'm working as a software engineer in USA for more than 6 years. I worked in top tech companies like Microsoft, Amazon for last 5 years. In the meantime, actually, I'm also passionate about tech and finance industries. I am a real estate investor. So I have multiple rental properties in different states. I am in the stock market for more than 5 years. I'm doing option investment for almost 4 years. As a part-time profession, I'm a long-term investor. I am a swing trader. Sometimes I also do day trade and also option trade. And my average monthly income from stock and option market is around $2,000 to $3,000. But it's depend on the capital. If you start with very small amount, that's not actually you can shoot for. And for this presentation, actually, I want to share my incredible findings of option market. And main question might be actually why now? Because we are working from home and actually we have some few times, and also the stock market is really volatile and you can actually get some benefit from the stock market. So what are the prerequisites you will need if you want to start with this option market? You will need actually basic knowledge of probability and stock market. Basic knowledge means actually you have to understand how probability works. If you know that actually the probability of event A occurs 50% of the time and another one event B occurs 60% of the time, that means you can safely assume that actually there is most likely the event B will occur then more than event A if you run actually a large number of times or actually do the experiment large number of times. You have to be open-minded, try to think logically and mathematically. Mathematically means actually you will lose a lot of money in the stock market and option market, but think logically and mathematically means actually your idea is to make more money, how much you lose. So yeah, I'm in the option market, stock market more than 4 or 5 years. I still lose money. So that's not the case, because actually if you will lose money, maybe $100, $200, your idea is actually make more money than whatever you lose. So other things actually from the capital perspective, if you want to start option market, you at least need $2,000 to open an option margin account. You need to access a PC or smartphone during trading hours. Minimum time required in weekdays, 15 minutes, I would say. So there, from Monday to Friday, you will need at least 15 minutes per day to take a look at what you are doing and how much your option is doing, and actually, do you need to close the position, or actually do you want to open new positions? Then I would say actually invest time to learn about option trading. So I spend actually a lot of time. So if you want to start, you will need at least 100 to 1,000 hours of maybe watching the YouTube videos, and also you can go to online, learn everything. There are so many information there. I would say sometimes actually it's information overload. And another thing, actually, you can join our online course. Our class cost is $1,000 for 10-hour class, which actually will do the hands-on training. Will show you how you can do the option trading actually, and how can so you can be profitable. And set up this expectations. Average monthly income, you would expect 5 to 10% of the capital. This is a monthly income, which is actually yearly 60 to 120% yearly income, if you consider only simple interest, right? So, but if you consider about the exponential, it might be actually more than 200% if you can consistently make 5 to 10% per month. So what the expectation level, if you open a brokerage account in $2,000, you can expect $100 to $200 per month, but you can get actually more. So, and that is almost, so you can actually double up, or actually make it triple by the end of first year. Do you have any questions, or should we go ahead? Or yeah, I think nobody has any questions. So yeah, so what are the prerequisite? Second thing, actually, you need a brokerage firm. You need to open an account. One thing, actually, there are a few brokerage accounts. I actually tested all of them. For option trading, I would prefer you will use the tastyworks. There is another mode that is called Thinkorswim. It's by TD Ameritrade. So these two are the best for the option trading. You can actually analyze all the options and everything. And then few other brokerage account is Interactive Broker, then Fidelity. There are few free brokerage account. One is Webull, another one is Robinhood. I would not actually encourage to do option trade in those two free brokerage account, because in Webull not all option strategies are available, and in Robinhood actually I would say this is the worst platform to do option trading, and it doesn't allow Friday expiration option buy, because it's the last day of the expiration. And the if you join the class, then actually in the class we will follow the tastyworks network. And some other platform you will need for the software, you will need so Thinkorswim, you will get the free with the TD Ameritrade account. And you can use Dash platform, that is $150 monthly subscription fee, but I would not encourage to get that one, because at the beginning I would actually encourage everyone to reduce your cost. Okay, yeah, there's all the prerequisites. So if you have any question, you can go ahead and ask me, and otherwise actually we can start what is option trading and how.
Hello, Imran bhai.
Yep.
Is tastyworks is free, or there is a monthly subscription?
Tastyworks is free. So if you open a brokerage account, maybe $2,000, you will get the software is free.
Okay.
And also, yeah, Thinkorswim also free. But yeah, I would prefer tastyworks, because tastyworks has a few other mathematical formula and everything, which would be useful. I'll show you actually everything, how does it work. So yep, so the tastywork platform looks like this one. You guys, if you guys can see the screen, this is actually tastyworks platform. You can see the list of stocks, and there are a few other things pretty interesting. In the watch list, you can sort based on the volatility, implied volatility. So yeah, and also the IV rank. Some of the platform will not give you that IV rank. Yeah, and tastyworks networks looks like this one. Let me to this screen. Yeah, tastyworks actually network looks like this, and you can have all the screens and everything. We'll show you.
So with free subscription, do they offer like all the services like day trading or option trading?
Yeah,
Like
they offer everything. So yeah, if you open a margin account, they offer everything.
okay.
And so yeah, but they charge actually fee. I think for the each contract, this tastyworks charge $1, and I think the Thinkorswim they charge actually 60 cents, 60 or 70 cents.
Oh, you are saying the commission
Yeah, for the
per
commission.
transaction.
Yeah.
Okay.
So they are mainly actually based on the commission. So for the option trading.
Okay.
Yep. So introduction to option trading. So what is option trading? So yeah. So I got the definition from the Investopedia. So everybody actually know about a stock, right? So if you take a look at the screen, then you can see that actually for the stock, what you can do actually everybody knows about the stock that actually you can purchase some amount of a stock with some values. So there are only two options. So if you want to buy maybe Microsoft or Amazon stock, what you can do actually for the stock, you have two options. One option actually buy the stock for example, what is the current value of the stock, right? So if the Amazon stock price is $1,900, you have two options only. You can either buy the stock, how much money you have, you can buy it to $1,900, and tomorrow or maybe after 1 year, if the price of the stock increases, you can actually sell it. If you have the stock, you can sell it. And there is another option actually short stock, but we will not talk about that one. So that is mainly the stock. And what is actually option? Option is actually an option is a contract giving the buyer the right. So what does it mean? Actually, option is a contract based on these number of stocks, and it gives the buyer the right, but not the obligation to buy or sell the underlying asset at a specific price on or before a certain date. So what does it mean? It means that, so for example, stock price for, let's talk about, make it simple, that actually Microsoft stock price is $150 right now. And you can buy the stock with $150. If you want to buy one stock, you have to pay $150. You can say if you buy it actually and the price increase maybe $160, you can sell it. And contract means that you want to sign a contract with the option buyer and option. There are two parties. One is option buyer, another one is option seller. So there will be a contract between the option buyer and the option seller, and that option contract have few other criteria. So what are the things? So let me go to an example that might be much more easier to understand. So everybody actually know the car insurance, right? So the car insurance thing is that actually if you buy a car, actually if you drive a car, most of the actually state requires you have to buy an insurance. So what does that mean? That means that actually this insurance contract is a contract between the insurance buyer and also the insurance seller. So for example, this is actually is a picture of a insurance card. What does that policy declaration means? That actually this insurance provider who is selling the insurance, the travelers company, actually the contract seller is the travelers insurance. And who is the insurance buyer? The person actually who is driving the car, or actually who owns the car, that lorry A test. So you can take a look at that. So you can think about actually this is the option buyer and this is the option seller. This is a contract. This is actually the insurance is a contract. And it has few other things. One thing actually, what are the underlying asset it actually covers? It covers the underlying asset, which is the car. Okay, it covers only the car. So you bought a car insurance, you actually it won't cover anything except car. Maybe actually a bicycle or maybe a house. It will not cover, right? Few other things actually, there will be a policy premium. There's a total policy premium. It says there's actually $373 maybe for 6 months or 1 year. So the insurance buyer has to pay a premium to get the coverage from the traveler's insurance. And okay, and what are so the buyer gains a right? A buyer gains that actually, okay, I'm buying the insurance, so if something happens to my car, then actually I will get the coverage from the traveler's insurance. But whoever is selling the insurance, the traveler's insurance, they have the obligation. If something goes too wrong with the car, they have to fix that car, or actually they have to provide the money to fix the car. So the insurance seller has the obligation, but buyer doesn't have any obligation. And few other things actually, there is the expiration date, how long it will expire. So if you understand the whole concept of car insurance, then actually we can go back to the option contract. So it's the same as this, that actually you will have a option that you can assume that, for example, Microsoft is doing $150. You can expect that next year Microsoft will go to $200. So you can buy a contract that actually Microsoft price will go up. But there are a few other things, right? Actually, there will be a few other important concept is underlying stock. Underlying stock means what are the stock you are talking about? You are talking about the Microsoft stock. There will be a contract to buy or sell. That means actually either you can assume that the Microsoft price will go up, that means $150 to $200, or you can assume that actually it can go down, maybe $100. So you can buy both the contract, either actually the call contract or put contract. You have to pay a premium. You have to pay a premium that actually if you want to buy that call, then you have to pay a premium. There will be a strike price. That strike price, what does that mean? Strike price means here actually how much you are thinking that the price will go up, maybe $200, maybe $300. There will be expiration date. So after the expiration date, same as like insurance, after the insurance got expired, there is no obligation for the option seller, or actually for the option buyer, you will not get anything. So if the expiration date is maybe after 1 year, then actually after 1 year you don't have any value of your contract, and you can't actually claim anything. And typically the number of stocks considered in the this option is 100 stocks. So for example, one of the example might be something like that Apple, AAPL, this actually 2020 0327, that means 27th March. C means call, P means put, and 250 is the price. This is the actual strike price. So let me give you an example. So actually, if you go to the tastyworks, this is not tastyworks, actually, this is Thinkorswim. So if you go to here, and then if you want to see trade button, so this is actually underlying, or maybe, yeah, for example, this is Apple, right? So these are these April 3 contracts. You can see actually all the contracts are here. So yeah, so you can see actually there from 115 started from 115 for next Friday. The contracts are actually till 390. There are so many contracts, is already open contracts. You can buy and sell these contracts. Current price is Apple is 250 right now. And so there will be two sides. One is actually the call side. Call side is the left side, and the put in the right side. So there are some few other information I can show you, that what are the probability and also implied volatility. So how much is the volume? So you can think about, if you take a look at the volume, you can see for 250 strike, or actually 247 strike, there the volume is almost 1128 million. This is actually 12 million, 13,000 million almost, the 250 contract. So yep, so that's how the option works. So do you guys have any question, or actually I can make it clear? How does it work? Or
so Imran bhai,
yep.
so there is two party. One is like option seller and option buyer. So
Yes.
only option seller has the liability, right?
Yes, option seller has the liability because he is getting the money. He is getting the premium from the option buyer. An option buyer has the actually right, but he doesn't have any obligation because you are paying the money. You are buying the insurance. So if you are the option buyer, you are paying the insurance. So you don't have any obligation because you are already paying.
But like if I have an option and I sold it to the market, so in that case, do I have any obligation?
Yeah, so you have the obligation. If you are selling on option, because whenever you are selling option, you are getting some money. So whenever you are getting money, you have the obligation.
No, I'm saying I bought it from somebody else.
Okay,
then,
okay.
yeah,
okay.
I'm
so
selling.
You bought it and now you want to sell it. No, you don't have any obligation after that. Because actually then after the selling, you don't have any, your portfolio will not have any stock or actually any contract.
Okay.
Yeah, same as actually the car insurance. Car insurance, you can think about that whenever you buy insurance, you cancel the insurance. So you bought the insurance maybe $600 for 6 months. Then after 2 months, you sold your car. You can actually just cancel your insurance, right? Then the company actually will get, the insurance company will get refund you some money, and they don't have any obligation.
Oh, another thing is like this option is for like 100 stock, right?
Yes,
so if
you
I
saw
want to,
100 stock.
if I want to sell an option, but I don't have like a stock, so can I still do that?
So yeah, so you can still do that. So, but you need that money. So, so if something goes wrong with that, you need that money in the brokerage account.
Okay.
Yeah, but there are some options we'll talk about actually how to make it actually you can sell. These are called actually naked call and naked put. That means you are selling or buying without having the stock. So you need that money in your brokerage account so that actually if something goes wrong, you can actually still buy or still sell that amount of stock.
So this is for only selling. For buying, there is no obligation.
No, buying
right?
there is no obligation because buying you are already paying. For buying actually it's like buying a lottery ticket.
Okay.
So you are buying an insurance or you are buying a lottery ticket. So if you buy a lottery ticket, so you are already paying. So they don't care, right? Nobody cares. You are paying for the money. Okay. Any other question from any other people? Yeah, I think no one has a, okay. Okay, let's this guy. Okay, put it here. Okay, so same as actually we can think about a if you guys have bought a house, you already know that actually this is also related to some kind of option, because actually whenever you give an offer to buy and purchase a house, then actually it will be a contract between buyer and seller, because you won't give the money at the time actually whenever you're signing the contract, right? This purchase contract will be a contract between a seller and buyer. So what are the key components? One key component actually you will think about what will be the underlying asset. Underlying asset will be a house. You want to buy that house. Maybe you want to buy that house with $500, $500K dollar. So the strike price will be 500K. The underlying asset will be this house. There will be a contract, right? There will be a date, expiration date. Maybe 30 days or 45 days, you'll sign the contract. Then expiration date will be the expiration date, that actually how long this contract will be valid. If you want to buy this, if you want to sign this contract, you have to give some premium to the seller. For example, some kind of earnest money. If you buy a house, you already know that you have to give some earnest money, maybe 1% or 2% of the total purchase price. So you normally give $10,000. Now, if everything works perfectly, there is no contingency, and you still back out, you don't want to buy the house after 1 month, then actually seller might not give you back your earnest money. Because seller give you this, seller signed the contract that actually you'll buy the house, but you don't want to buy the house anymore, but there is no contingency in the contract, then actually seller might keep that money. Yep, those are the similar example with actually how it relates to option. So okay, one interactive question for you guys actually, what are the causes for option premium to change? So what do you guys think actually? So based on the house purchasing example, or based on the car insurance premium example, do you guys think actually what are the key component what might change the option price? Because if you go to in the I can share you these guys, right? So for each of the $200 or $250 call, if you want to buy it, this is right now actually $9. The last price was $9. So keep in mind that $9 means actually for one stock. So if you want to buy it, you need actually $900. So what do you guys think actually? What are the key components what might affect the price of the contract?
I think market condition, like if market is volatile, and also like how much time do I have to reach the strike price?
Yeah, so one option you are saying market volatility. Okay, yeah, that's one factor. Because what do you guys think actually? If the market is volatile, that means strike price is changing maybe crazily. So will the option price will go high or low? What would be the relationship?
The option price will be more volatile than the stock price.
Yeah, so the price will go up or down.
It depends. If our strat, say if I bought a call option, and if I'm reaching close to the strike price or above the strike price. No,
that's not the case. What I'm saying actually, think about actually everything is constant. So if you think about the other moving components, then it will be difficult, right? So you think about actually only the market is volatile, everything is constant.
I think
all
it will
other
be
things
higher.
are, yeah,
It will
option
be
price
higher.
will be higher.
It will
Yeah.
be much higher.
Yeah, so option price will be higher because actually the market is volatile. So now
Yeah.
it's a good time for option market because the market is really volatile and actually the option premium is high right now.
Yeah. So I think
yeah.
this is the same thing. Like if there is like more accident in a state,
Yep.
then insurance premium will be higher.
Yeah.
Right?
So for example, same is right. Actually, if some people has the driving record has actually he is always doing the speeding, right? He always drives maybe 200 mile sometimes. So if insurance company gets the this driving record, the insurance premium will be higher because he can do accident anytime because he has lot of speeding tickets, something like that. Any other idea? What are the other components? One is actually, Khurshid was saying that the duration. That means if the duration is low, then the option price will be low. And the duration is higher. Maybe actually you want to buy contract for 1 year. Then actually, what do you guys think? The price will go high or low?
Is there a effect of dividend as well?
Normally it doesn't, but actually the implied volatility, the volatility might affect, so it might affect the price. But you don't think about other things whenever you're considering. So you'll think about the as independently.
Okay.
So yeah, if there is a dividend, then actually price might be different. But what will be the case if the duration will be go higher? Then premium should be go higher or lower?
Premium should be go higher.
Yeah, premium should be always go higher. Okay.
Say for
any other things?
The one that you just showed, $250 for Apple price, the option price is $9 in 1 month. But if it is for 6 months, it would be like $15.
Yeah, it will go actually higher. If you go to the actually same thing, this is actually 3 April. So if you go to the 15 May, if you go to the same 250 call, you will see that actually 250 call is almost $23. Previously for this week is actually $9 only. Any other things? So one is actually we know that duration. That means if the duration goes higher, then actually the price will go higher. Another one actually the market volatility. If the market volatility is high, then actually price will go high. Any other thing? What do you guys think about the 250 contract and actually 220 contract or 200 contract?
Or strike price actually.
Yeah, the strike price. That actually the $200 strike price will be always less. So if we go back to our this week option, then actually if the strike price goes higher, then $200 is actually $48 call. If you go, so it's depend actually is the call side or put side because 247 right now actually the call, right? So if you 247 is currently is here. So if you for the call case, the price will go higher. If you go up, then actually that price will go down. If you go down, then actually price will go up. And the put side is different. It is actually totally opposite. Another thing actually, so the Apple price is $250. What do you guys think actually if we buy the call for Microsoft? So the price will be higher or lower? Same option premium, maybe 200 option premium, same strike price.
I think lower.
Yeah, because it depends on actually the underlying asset. Same is actually for the car insurance. You want to insure a Toyota car or actually you want to insure a highly costly Mercedes car, right? So if the price goes higher, then actually the option price will go higher. So this is actually underlying stock price.
So I have a question. So in that case, actually option, we are making profit based on the derivatives, right?
Yeah.
Based on the change.
Yeah.
So how does it affect based on like a high like price stock and low price stock?
Yeah, because for example, think about this one. So if you want to sell a put and you want to buy something, right? So it's only controls the 100 underlying stock. So for the Apple, you are getting $250 right now. Price is $250. So $100. So 100 it will be 25,000. For the Microsoft, it will be only 15,000.
Okay.
So you can think about something like very easily that actually if the Apple is 250, what is the probability of going to 250 to 260, the $10 change in Apple, then actually in the Microsoft 150 to 160.
Oh yeah,
Which probability will be higher?
Okay.
What do you guys think, Apple or Microsoft? Obviously Apple, because actually Apple has less percentage, right? So 10 out of actually 250 percentage. Okay, so yep, let's go to the next. So yep, so the main reason actually for the options premium to go up and down, that actually current price of the underlying stock, change of price of the underlying stock. So if the, for example, Apple is 250 right now, but tomorrow it will become 270 for any reason, then the option price will change, because now actually all the things has been changed from yesterday to today. Change of strike price, that means actually which strike price you want to buy the contract, length of the contract, and also the last one is market volatility or implied volatility. So what I was telling you guys, that actually market volatility is the important factor right now actually to be in the option market. Okay, so next question is actually why we want to do the option trading, not trading the underlying stock. That means we can buy the stock individually. Why we want to do the option trading? One question is actually currently the market is volatile. You don't know actually what is going to happen tomorrow. If the Microsoft price is 150, you don't know tomorrow will be 140 or actually 160. So that's one thing. Second thing, actually day trading restriction. So there is a one day trading restriction that actually in your brokerage account, you cannot buy or sell same stock or same contract more than 3 times in a week. So if you actually buy, for example, Microsoft 150 stock, maybe 20 stock maybe today, and you want to sell it, maybe it increased to 160 in the afternoon, you want to sell it. So you can do that same thing, same day trading, only 3 times in a week. You cannot do that more than that. So that's one restriction. So for trading a stock, you need actually a PUT rule. It's called a pattern day trading rule. So that day trading rule tells you actually you need at least $25,000 in your account to do the day trading. So if you don't have $25,000 in your margin account, you can't do day trading. Second thing, probability of choosing direction of a stock value. So what do you guys think? So if you buy Microsoft stock $150 today, what is the probability that actually tomorrow the price of that Microsoft stock will be more than 150? What is the probability?
50%, right?
Yeah, 50%.
In this market situation, it can be less than 50%.
Yeah, so if
right?
you think about everything is constant, then actually you don't know anything about anything. So if you just buy a stock, you don't know anything about the stock market and anything. So you just buy a stock in Microsoft $150. But what is the probability that actually tomorrow will be more than 150? It's actually 50%. You don't have any other. So it might go up, it might go down. You don't know. So for the option market, so the probability of buying a stock, keeping everything constant, this is actually 50%. But for the option market, you can choose high probability of trade. So there is a thing that actually you can find those contract which has the high probability of success. Few other things that actually you need less time required, because if you want to do day trade or if you want to do some other things, then actually it will take long time. But for the option trading, you can actually do it in maybe 15 minutes per day. So it's less time required. Same thing, actually less money required, because actually you don't need a lot of capital. Because think about this, that actually, for example, you want to buy 100 stock of Microsoft with $150, you will need $15,000, right? You buy it today, and after 1 week, it become $160. You want to sell it. So what is your rate of return? You invested $15,000. You got it only $10 per stock. So $100, you'll get $1,000 by investing 15,000. But what you can do actually, if you know that there is a chance that Microsoft will go to 160, you can buy the same call. You don't have to spend $15,000. You can buy that same call, maybe the option price, we can take a look. It might be actually $7 to $8 for 1 week or 2 weeks. So $7 to $8 means actually you can invest $700 and you can still gain $1,000 if the stock price still goes up by 160 by after 1 week. Then you invested only $900 or $800, but you can gain 1,000 out of actually $900 in a week or 2 weeks. So,
but in other way, we can lose the entire $900.
Yes, other option is actually you might lose all the $900. That's actually trade.
If you buy the stock, then you will not lose because you have the option. You have the.
Yeah, so same thing. You can think about that, right? Actually, if your stock price goes to 140 after 1 week, what will happen? So
You can
140,
wait,
you can, if you
right?
want to sell it, you still lose $1,000, right? But if
you
you want to
can
keep
wait.
it, then it's fine. Yeah.
Yeah.
So then actually it doesn't make sense.
Okay, but to profit, I think we need to go like 167, right? Because I'm paying like $7
yeah, if you
per
paying
share,
$7, so yeah, you need to go to $167.
then it will make profit.
Yeah, so actually if you want to wait till the expiration, then actually you have to more than 167. If you don't want to wait till expiration, maybe you bought actually 1 month contract, then you can sell it, right?
Okay.
So there is a good trade-off between the capital efficiency and time efficiency, because what I want to say, actually, if you spend more time, you'll get more money, right? If you actually spend more capital, then actually you will get more money. So there is a good trade-off between actually capital efficiency and time efficiency. And there is an option in the option market that actually unlimited limit profit potential with less probability. So if you still want to do some sort of trading, you can get actually unlimited profit potential with less probability, but I would not encourage this one. So what you can do, actually, you can think about that Microsoft stock in next year, it will go 200. You can just buy the contract, but Microsoft stock might go to 300, 400, 500. So you will make actually maybe 500% or 1000% of your invested capital. But I would not recommend that one right now, at least for the starter. Okay, yeah, so that's the basic thing. So what are the current market conditions and opportunities? So why I'm offering this class, and actually what are the opportunities? So there are two types of stock market. One type is trending. Trending means actually either the price is going up or price going down. And another one is actually the range bound, but trading market. Trading market means actually market price is actually bound into two ranges. So for example, Microsoft stock price might actually just swing between 150 and 160 for 1 week. So that is called range bound. So what do you guys think actually right now? What is the market condition? There are three types. One is actually bullish, means actually price is going up in the longer time frame. Bearish is actually going down. And now actually the trading is actually it's swing between. So based on current market condition, maybe today or yesterday or 5 days market condition, what do you guys think? Is it a bullish market, bearish market, or it's a range bound market?
Range bound,
Bearish.
I guess.
Yeah, it's actually difficult to tell. Range bound we can say about actually maybe 1 week, but if you consider the last one, so let's go to actually some graph. So if you want to see what is going on, so for example, this is Microsoft stock, right? So if you want to think about from last month, this is actually a daily chart. I'll talk about, okay, maybe actually you can go to the next slide and then we can show you actually what that means. Okay, we'll go to the chart. You need actually to understand a few things if you want to actually go to the chart. Most of the traders actually use this candlestick chart. So what does this candlestick chart means? Candlestick chart means that these will be represented, the price of the stock will be represented by a candle. It's like a candle. There is a body and the other part is called wick. So these actually straight line down, this is called wick. This is also called wick. And this middle part is called the body. There are two types of candlestick. One is actually bullish candlestick. Bullish candlestick means actually price is going up. And there is a bearish candlestick, price is going down. So if you want to consider the 1 day candlestick, 1 day candlestick means actually this candle represents 1 day of the price. So if price, so for example, if the Microsoft price started with $150 in the morning, and at the end of the day, it become $160. So that means actually from morning to evening, the price actually has went up. So it's a bullish candlestick and it will be shown as a green candle. If the Microsoft stock price started with 150 and at the end of the day, it becomes 140 or 135, then actually the price went down, then it will be a bearish candlestick, it will be shown as a red. So if it goes up, then actually the lowest part of the body represents the opening price. The highest point of the body represents the closing price. And what are these weeks? These weeks means in whole day, Microsoft might go to 150 to 160, but in whole day, Microsoft might actually go to 110, maybe at 11 a.m. Then this low point will represent actually what is the lowest value in that whole day. And Microsoft might go to $200 also in the whole day. Then actually that highest week represent actually the highest value. And this is totally opposite for the bearish candlestick, because the upper part is representing the opening price and lower part represents actually the closing price. Okay, so let's go to the now actually if we go to the chart, then actually we will be able to see what does that means. So you can see actually all the candlestick here. You can see actually some green candlestick and some red candlestick. So if you want to think about, for example, this red candlestick, which was actually the Friday, right? Friday 327. So what do you guys think about this red candlestick? Is it actually price went up or went down? This red candlestick, what does it mean?
Red is down.
Yeah, red is down. If red is down, the upper point represents what? Start price or the end price?
It's the start price.
Yeah, if the red, then actually the upper price. So that means Microsoft started with 151.75 in the morning on Friday. That was actually this upper. And this is the lower part. That means Microsoft ends the price 149.69 at the end of the day. And these are the weeks. Weeks means actually what is the maximum value it reached actually in some time, some part of the day. That is actually 154. And this is the lower week means actually some part of the day it went to actually 149.70. So if you go to Tesla is actually more volatile. So you'll be able to see actually more up and down here. So yeah, so same as this one actually. So the difference will be much higher or lower. So for example, if you think about 19 March, it started with here and actually goes up to here for the green. Okay, so we want to show you actually what is the actually range bound market and few other things that are saying actually is it actually going up or going down. If the price, for example, going down like this, it's called actually bearish market. If the price is going up, then actually it's called bullish market. And if it is actually between two range, then actually it's called range bound. So if you go back to the graph here, I can show you that why from March we are saying that actually it's going up. So for example, if you think about December price, add a drawing from. So the price started from here, the lowest price. If you actually connect all the maybe end price, or if you connect most of. So if you think about this straight line, you can think that actually price is actually going up. It's a longer time frame. In a daily time frame, it might actually go up, go down. Anything can happen in the going, but actually eventually after from December to February 20 or 30, February 2018 or 30, something like that, actually it is going up, right? So if you just take this one to here, right? Let me do one more drawing. So if you consider like this one, if you connect all the strike price, so actually till 17 of February, it was going up. The price was going up for the Microsoft. And if you connect these lines, then you can see that from here, it's actually going down till last week. It was just going down. So yeah, so you know, actually you heard all the time that actually in the 11 years of bullish market, so price was actually going. If you think about the maybe more longer time frame, maybe weekly, so that is actually it's going. You think about last 3 years, actually started from Microsoft stock started from 3 years back was 65. It came to actually 190. So whole these 3 years. So it was actually bullish market. Price was going up. Although individual day it might go up and down, but actually in the longer time frame it was going up. And from there it's going down. So now actually it's a bearish market. And if you think about maybe smaller time frame, you can think about something like look at this smaller time frame, something like here. If I do a drawing from here to here, you can think about how long it was just trading range. So drawing here. So these almost few months, almost 1 year actually, the Microsoft price was from here to here. It was just actually going up and down. So it was range bound. Okay, so yep, next go to the next slide. So what are the other things? The current market is volatile than normal market condition. So right now, actually, the market is volatile. That means the range, that is average true range, how much it can go up and down per daily basis average, that is actually very high. And if you go to typical option chart, you will be able to see that actually the option price was really high. That's called volatility index, VXS. It's also too high right now, actually 60. So if you go back to the chart, if you just take a look at the VXX chart, this is called volatility index. So look at this. The volatility index was till this is one. Let's make to 1 day. Yes.
That's VIX, right?
Yeah.
VIX.
Yeah, so here VIX was actually till February was actually this till now in 60. Right now actually somehow actually it reaches to still 66, 67. So if the VIX changes, price changes, the price of the option also changes. And so option premium is too high due to there is volatility. So it's actually best time to sell call or put options for premium. And another recommendation, actually you always want to close the position before the expiration date is highly recommended, because you don't know the market, what is market is doing. So it's better if you get a profit, you actually, I would suggest take the profit and actually close the position.
So Imran bhai,
Yep.
So if I want to close the position, is it guaranteed that I can do that if there is no buyer?
Yeah, so that's why actually whenever you buy an option premium, buy anything, you will always take a look at the value of these two things. One is actually the open interest, another one is the volume. So for example, this is Microsoft, for example, right? So Microsoft price is actually 149. So look at these, actually the different strike price. The open interest is 22 and 1 for the 90. So if you buy maybe, for example, this is 150, right? 150. So look at these, the 145 option that has open interest actually 1131 and 1354. So if your volume and open interest is pretty high, then you are guaranteed that actually you will get a fill. But if you buy very low volume or open interest price, there is a chance that actually you won't be able to close the position.
So what does the open interest really mean?
Open interest means actually how many open contracts. So normally this contract, when you buy it from the brokerage account, right? So open contract means actually how many individual seller or actually institutional seller bought this open contract. And for example, some people actually maybe 100 million, that is open interest. But after 2 weeks, it becomes maybe 100,000 only, because you know that that price won't go up that much. So most of the institution, or actually whatever you buy it, you actually close that position. So the open interest will go down.
So the volume is the amount of contract is being bought or sold on that day, but that open interest is
not a whole day actually, because
the volume is the whole day, right? Volume is the whole day.
Not
is that right?
This is actually total volume. This is not actually whole day, because
Total
you don't know actually how many contract has been done, because this is actually 1354. This is almost 1.3 million. This represent actually whole contract has been transaction, right?
Within how many days is it?
No, within days, right? Because actually this is actually this 145 contract, it will expire on next Friday. So any time actually between this time.
So this value can change based on like if the price is moving towards the strike price.
This value can change based actually if you buy or sell, right? So if there are more people is buying, then actually these will go up. So if you want to buy or sell it, it's better to actually take a look at the highest open interest or highest volume. That means that actually whenever you want to close it, there is an option that either buy or sell, you can do that.
Yeah, but I'm still not sure about the open interest. Say if you go down and see the 3rd April 160 price,
yeah,
the open interest is much higher than the volume. So what does it really mean?
So these open interest means how many open contracts in the market. So
okay, how many contracts are available?
Yeah, not available. How many open contracts are there? That means actually how many people, how many contracts has been bought by the buyer.
Or is there any effect of like sometimes we do like a place call like Q, means I'm saying that if the price range 150, then I will buy it, means
Yeah.
limit order. So
It doesn't is the open interest actually. Whenever you the
okay.
transaction happens, then actually that goes to the open.
Oh, okay.
But for the volume, I might dig deeper. Maybe actually we can take a look. Actually, it's not for day for sure, but
Okay.
what goes to the transaction, because open interest means actually how many open contracts is there, but the total volume might be both the open contract and also the closed contract also.
Okay.
Okay, so.
Okay, so as you are in the screen, was that you mentioned about the implied volatility? Can you explain that parameter a little bit? Like, what's that? Like,
so implied volatility
all over the place.
means, whenever there is a mathematical formula which calculate the price of this stock, option. So how we are getting this price, right? Price of this 150 stock price. So there is a mathematical formula. That mathematical formula has actually parameter which takes the implied volatility. So if the implied volatility is higher, that means actually the option price will go high. So I don't know exact mathematical formula, but I know actually the relationship that actually if the implied volatility is going higher, then actually the price will go higher. Implied volatility goes lower, then actually it goes lower.
So implied volatility of individual strike price, like yes, here I can see, price. Yeah, like in the lower price range,
yeah,
we have a higher implied volatility compared to the higher price range. So
yeah,
that means it's
for
more
the call side, but for the put side it will be different. Put side will
okay, right.
be the other way around.
Yeah, so it should always be that way, right? Because
yeah, it's always be that way.
Imran, I have another question. So is there a relation between put and short selling?
Yeah, because put means
same thing.
You are assuming you will the price will go down.
Okay.
So, but what you are actually, if you are selling a put, that means actually you will buy a contract. You will buy 100. If the option is exercised, you have to buy that strike price 100 stocks from that brokerage company. Another thing actually, okay, so yeah, there is another probability is probability out of the money. So you can actually think, you can see actually all the probability of these guys, how the probability has changes for between the strike price. If the strike price changes, then actually the probability of out of the money also changes. Okay, so.
And the other parameters are
so
mainly
some other parameters is there. So one is delta. Delta represent actually how much will change. So if the delta is, for example, look about, let's go to 7, right? It's 0.11. That means actually if the price of the stock changes $1, these option contract, if everything all the other things actually is constant, then the price of this option premium will change 11 cents. So delta represent actually how much it will change based on the price of the stock. Few other things, theta represent actually how what is the time decay. There is a mathematical formula which depends on the time decay.
Mm-hmm.
Okay, so.
So I heard there is like a term called intrinsic value, extrinsic value.
No, only intrinsic value, no extrinsic value. So there is
intrinsic
value
okay.
actually or the price of the stock, and then there is a time decay, because if the time goes down, right, actually then your price also going down. So intrinsic value means actually, for example, Microsoft stock was actually 150. You bought a call for 160, right?
Okay.
And now Microsoft stock is 165, for example. So now, what do you guys think that actually, if, for example, the stock, the expiration, the contract will expire tomorrow, right? And right now, actually, the Microsoft stock is 165, and you have the call of 160. So you know that actually, if the Microsoft stock just reach, or actually just stay there 165 by tomorrow, then you will have $5 profit, right? Because
no, actually we paid premium, right? So
yeah,
we need
so
to calculate.
we are not considered, just
Yeah.
forget about the premium, whatever you paid.
Okay.
So yeah, so there is the intrinsic value, that actually the price difference between the strike price and your the stock price, that will be the intrinsic value, because by tomorrow, maybe you, for premium you already paid $1 or something like that, so don't think about that one. Now actually, if there is a time duration limit, because actually it will expire tomorrow, so you don't think that actually the price of that contract will be $5, it will be more than $5, it will be $6 today. So but whenever actually the time is going down, that $6 will become $5 at the end of tomorrow, when actually the expired. So you will only have the intrinsic value after the expiration. Any other question? So yep, what we are offering, so for the class, we are offering, we'll start actually next Sunday. So we, in the class, we prefer to use tastyworks network brokerage account, because actually it has more options, actually more suitability for this is actually new software. Also, if you want to open an account, you can use our referral. If it's up to you. You need at least $2,000. If you are interested about the class, you can register for the class. And a little bit about the class. That class will start next week. Number of classes will be total 10. The prospective students will be beginner intermediate level with access to capital and PC or smartphone you need. And all the class include hands-on training. The class format will be actually the theoretical explanation for 30 minutes, what topics we want to read. Live trading example or analyze past trade, that is 15 minutes, and then last 15 minutes, how to help the individual students answer questions. These are the actually syllabus for the whole class, 10 days. First class is introduction to option and why option trading. Class 2 actually how to use the platform, how to do the chart analysis, how to actually, what are the technical indicators I use in my option trading. Class 3 is call and put options. From class 4 actually we'll do the live trading with the trading calls and puts. And class 5 is naked options and vertical spade. Class 6 is covered calls and iron condors. Then class 6, 7, 9 class is important, that actually trade environment and psychology, because psychology is very important for the actually any type of stock trading or actually option trading. And finally, what we can go from there. Tentative classes schedule. These are tentative classes scheduled based on the instructor and actually students' availability. So mainly it will be Tuesday and Thursday 8 p.m. And Sunday 11 a.m. And total cost of the class is $1,000. I would say actually this is incredible value considering the profit potential in 6 to 12 months. And you will have at least class cost breakdown in 1 to 2 months. And the final thoughts that actually this is just the beginning of an interesting and challenging journey. If you understand actually how the option market works, your life will never be same. And for the class, if you registered, you will get actually at least 2 months of free subscription of the discussion chat group. So in the chat group, we share actually what trade we are doing. If you want to actually duplicate those trade, you can do that too. There was 50% discount, which actually expired on 27th March. Already few of the people actually already registered for the class. So if you still want to join by today, we can give that 50% discount. And you can just actually send an email to this if you are interested. And some question and answer that actually, few question is actually, is it guaranteed that I will be profitable? No, there is no guarantee. We can say that actually the probability of 70 or 80%, but you might not be profitable. Will I be profitable in every trade? That is highly unlikely that actually you will be profitable in every trade. You will have a losing trade at least 10 to 20% of the time. But you want to make sure that actually the losing trade will be less costly than actually whatever you are making. Can I lose all of your my capital? It's highly improbable, but in the worst circumstances, you can lose all of your $2,000 if you open brokerage account. You already know actually, whoever in the stock market, you already know that you can lose all of your money. Is investing risky? Yes, everything is risky if you don't know what you are doing. If you don't know how to drive, driving is really risky. And actually you can put at risk actually all the community people or the actually people of your family if you don't know how to drive. Can I consistently make money? Yes, with high quality, you can actually consistently make money. Yeah, so if you have any question, you can go ahead and actually, yeah, it's your floor now.
Oh, I have a question actually. I forgot to ask. Can you tell me more about dividend risk of option?
Can you repeat? So
dividend risk. I heard if you, I'm not sure if it is for buyer or seller. Like if you have an X dividend date and you have an option,
yep.
Sometimes you will be assigned those stock, and you need to pay the dividend.
You don't have to pay the dividend. The thing is that actually it depends on actually who has the call, right? So if you sell a call, for example, you have 100 stock, you sold a call, right? And that means that actually whoever has that call, he is controlling the price of the those underlying stock, 100 stock, whatever you own, right? So that means that guy has the opportunity to get the dividend. You don't. So it depends on actually, it depends that the expiration date and also what is the dividend date, right?
Yeah.
If you hold, you have 100 stock, you most likely will get the dividend. But what is the risk? You sold a call. You sold a call means actually someone bought a call from you. Then actually he's legally supposed to get the dividend. But this depends on actually some other agreement also. So if you open up or actually want to buy a contract, then you will be able to see that will you lose that dividend or not.
So this is only risk for seller, right?
This is only risk for seller, yes.
Okay. Actually, that's
but
confusing actually.
So which stock you are talking about? Normally the dividend is less than 1%. You will make 15-20% in a trade. So
no, it's still actually it's I think significant amount, because you have 100 stock, and even if you're paying 60 cents per stock, it's $60, and if you have multiple call, so all of a sudden you need to pay some money.
Yeah, so I would say actually for our class also, we don't recommend actually buying option. So buying option is like buying a lottery ticket. You are expecting that going to happen, but most likely actually 90% of our trade or of my trade for the option trading for the class also, what you will show mainly actually how to sell option, not to buy option. Because if you think about actually car insurance, who make the money? You bought the car insurance. Do you think you make the money, or the car insurance company is making the money?
But there is risk, there is obligation.
Obviously, so that's why actually you want to know how to reduce the obligation. But the good thing is that in the car insurance, for example, you sold a car insurance, the car insurance company sold a car insurance. Yesterday, somehow I know that actually you are a risky driver. Can they cancel the insurance? Or can they actually that return back? They can, might be based on the agreement, but in the stock, if you know that actually this is a risky, you will just buy it back if you sell the insurance.
Okay.
But the good thing is that actually you can do some high probability of trading in the option selling. You can do actually high probability of, so you want to shoot for at least 75% probability of success. If you don't have that one, then actually you will most likely. So if you think about something like that, if you buy a stock, there is a chance of 50% it will go up or down. But in the option, you can do some option which is actually more than 75% probability. Then if you do more number of times, right? So maybe large number of times, 75% of the time actually you will be profitable. And
so I have another question.
25% of the time you want to reduce the loss as less as possible.
Means you are reducing the profit as well, but you are trying to make it more consistent.
Yeah, right? So that's the main thing actually. So if you want to make it consistent, so if you have $2,000, by the end of year you want to make it $4,000, and you want to make it 75 to 80% probability. Won't you do that?
Yeah.
So if you invest $100,000, if by end of next year you will have $200,000 with 75 to 80% probability, you will obviously do that. Anybody will do that.
So Imran bhai, you said you typically, you or your team typically recommend selling the option.
Yep.
So like I saw in Robinhood, you cannot really do the sell call or sell put option unless you have the position on those.
Yeah, so
like
Robinhood has a lot of restrictions, so we don't.
Mhm.
I did some option trading, but I tried. I said that I tried 7 brokerage accounts, so I already have all those active accounts. I know actually Robinhood is the worst platform actually to do option trading.
Yeah, because they don't allow you to do the sell option first unless you have those 100
Yeah,
stocks.
they don't
in your
actually
account.
allow all the I would say actually vertical spread, but in other platform, the Think or Swim or tastyworks, Fidelity, Interactive Broker, they always allow that other actually complex strategies.
Yeah, I think for some stock they offer, like if you do the spread, credit or debit spread, then actually there is a corresponding put, sell, and buy as
Yeah,
well.
that means for those spread. That means you are already saying you are buying and selling at the
Yeah,
same
yeah,
time.
yeah.
So that means you can do it, but you
Yeah.
cannot do just one stock for sell, like sell one contract of
Yeah.
Microsoft at 140 or
Yeah, so
$160.
in that case, if it doesn't allow, normally the thing is actually if you want to, so you want to know actually what is the obligation you are. If you are selling, for example, if you want to sell $150 put, you will net $15,000 in your account. Otherwise, you can't sell 150 put for Microsoft.
It depends on the premium, right? Like whatever the
No.
premium.
It doesn't
I
depend on
think
the
stock
premium.
price also
It will not,
matter.
because
Yeah.
if you are selling $150 put, it means that at the end of the expiration, if the Microsoft stock price is maybe $100 or $90, you will buy from that buyer 100 stocks of Microsoft with the price of $150.
That
So
means you have to have $15,000 in account.
Yes.
Mm-hmm. Yeah. So that means with the $2,000 of investment, you really can do maybe the sale option for $20 stock. Other than that,
No.
right?
No, we'll do that. I can show. I haven't shown you actually so I created these account tastyworks account actually just for the class. So this is my tastyworks account. So
Yeah.
look at this. I already sold. So don't get too excited because I just opened last month with $2,000 for the class. So I'm up already $600. But it's actually typically not really happen. So, but yeah, for the Tesla, look at this. I sold that Tesla put 440 and 435. So, but actually the capital requirement is $500. What you need to do actually, if you sell that credit spread or actually call spread or put spread, you need to have the difference in your account. So I sold a put 440 and bought a 435. So I need cap requirement $500. So I need to have
Okay, because that was a spread call, not only the sell call. Like
yeah,
you didn't only sell.
It's not actually naked. So I wouldn't actually, I do most of the time, I do actually 15 to 20% of the time, I do naked call and sell, but I wouldn't recommend anyone who doesn't know what they're doing. So don't sell naked call or put, because there is unlimited loss potential. You might lose actually more money.
Might lose everything.
Yeah, you sold Microsoft Tesla $400 put, and Tesla becomes $50. You will lose to 350,000.
Mm-hmm.
Don't do actually this naked call and put. This is very risky because if you don't know what you are doing.
It is not selling, right? Buying, there is no problem.
Yeah, buying there is no risk because actually buying you are paying.
Yeah.
You are selling. Whenever you are selling, you are getting the money.
Yeah.
Any other question, or maybe you can?
No? Okay.
Yep.
So can you just show what did you really do in this 2 transaction, as we have some time?
This
just for understanding, what did you do?
So let me go to that. Let's see, activity. Field.
Yeah, for Zoom and Tesla. Yeah.
So maybe for the Tesla, what I did. So for the Tesla, I did I did it on 26th of March. I sold a call of sold a put of 440 and bought a put for 435, and I got the credit of $125, and this will expire
Okay.
on April 17.
So your target is, if you can explain this one. So you are saying on April 17.
I'm expecting that actually the price will not go less than 440. I'm expecting actually the Tesla price will be more than 440 at April 17. If I want to keep this contract till April 17, but most likely actually I will actually buy it back before that.
You will cover it, yeah. But say right now the Tesla price is 520.
Yeah.
So what will happen if market turns green and Tesla price goes
if
like
market
600?
turns green, actually I'll make profit. So look at this. I already make, so in 2 days I already make $30 profit here.
Okay. So at that time when you bought that, when you do that spread, so this one is a debit spread, right?
It's a credit spread.
Credit spread. Yeah. Okay. So for that credit spread, that you bought it on 326. So at that time, the price was
127 actually, 127.
Okay.
So if I want to close it now, I will make actually $30 profit in 2 days.
Mm-hmm.
But if the Tesla price go high, that means actually right now 514. If it goes high 600, this I will make more money. If it actually maybe reaches down maybe 400, 440, then actually I will lose money. I will start losing money. If it is maybe less than 490, then actually I will keep losing money. But if that is the case, I might actually cover it before maybe next week, right? If I see that Tesla is going to 440.
So 440, and you bought it at like 127. So your break even is around 441.3. Okay. Yeah.
Yeah, but if Tesla goes less than 480, I'll most likely cover it. I'll take the loss and cover it maybe $10.
Okay, so that's how you were saying to minimize the risk.
Yes.
Yeah. And what did you do on Zoom? Because that's going up and up, right? So let's see.
Yeah. So Zoom, I think I did the same actually. I did actually. I sold a put spread of 120 and 115. So I sold actually 120 and bought it 115. Most likely the Zoom will not go to 120. So I don't have to close it. So I got $185, and it's actually May contract, maybe 1 month more. But actually, yeah. So if it in 2 months, if the June price is more than 120, I'll keep this $185.
So what's the maximum? Okay, so yeah, if it is going down, then
yeah, then actually the difference might actually reduce, right? So right now it's 185. 185 I bought it. I got 185. Right now actually 155, but this difference will go up if the price goes down. But the good thing is that actually there is a time duration also, right? That actually time is changing. So if the time is reducing, if you sell the insurance, you always want to take that actually. If after 1 month, I might actually close the trade because I already got most of the money in 1 month. It's a 2 month trade.
Mm-hmm. So for both of them, it's a credit spread.
Yeah, normally I do credit spread. 90% of the time I do the credit spread. Yeah, for a small account, you have to do the credit spread. That's the only way to go actually to increase your actually capital. You can't do actually naked call or put with $2,000.
You can do, right? Why can't you? Like
selling,
for
you cannot do
$2,000, I can do
selling.
only the penny stock, right? I can actually sell maybe.
Yeah. Okay. So naked call or put means you cannot do the sell, but you can do the buy. Yeah. You said the sell.
Buy
is
you can do that,
option.
but buy probability is
Yeah.
less, right? So if you,
got it.
for example, if you go to, for example, trade, right? So just look at the probability, right? So for example, the June price right now, the probability of, for example, if you want to still buy 170, you need to pay $410.
Right.
So you are actually losing 25% of your account if you don't reach 174. So do you want to do that? The probability is very less, right? Because you have only $2,000. We sometimes actually, because for my other account I do, but that's very less than 10% actually I buy sometimes call. If I know that actually price is going up, for sure that price will go up, then actually I buy a call, or actually maybe that's most likely 1 or 2 day trade. I don't want to do for actually 2 months or 3 months. So because in that case, in each day your the day decay is actually reducing. So if you sell a call, then actually you are making money if 1 day is passed. Same as insurance. You bought insurance for 6 months. You didn't, for example, it's right now in coronavirus, you are not driving anything. What you are doing, in each day, you are actually reducing your premium. The insurance company is happy because you are not driving. Your car is not at risk, but still they are making money in each day. So because each day they are making money. Any other question from other guys?
Say for, I just have one more question. So in your position, you said, what's the maximum earning potential on that call, on that credit spread?
Whatever I already got, because for
Say
June,
you
185, I'm risking
so you
$500. So I'm risking $500 to make 185 with the more than 80% probability.
why you said you are risking $500?
Because
$500 is required,
Maximum
right? Yeah,
loss.
go ahead.
no, 500. If it goes down in 2 months, if I don't close this trade and June go to less than 115, then I lose $500. But I won't let that happen, because even before it touches 120, I'll close the trade. But still, if it goes in May 15, if the June price goes to 100, just 1 cent less than 115, I lose $500.
And then what's the max earning potential?
No, max earn I already earned. So
You already earned. So that's the highest one.
I already got $185.
Yeah.
So if you think about that, 500 minus, so max loss potential is actually 500 minus 185. So $315 max.
Right, because you have already got that.
I already received $185.
So for 185, so that means for both this contract, you already got those money, and that's the maximum you can make. Yeah. And then the maximum loss is the capital required. So that $500 capital required, that depends on the difference between your strike price and the call, or? Yeah,
so that is actually the difference between the 2 strike price, whatever bought.
Oh, okay, 2 strike price. Yeah. Got it. Thank you.
Yeah, sure. No issue. Yeah. So if you're interested about the class, you can just send me an email with the techfinguy@gmail.com. If you don't have I can send the email too.
So just to just for out of curiosity, so do you like, is it a organization you are running, or is it just yourself got the learning and do the practical trading, and now you are helping others to get money? Is that you are alone, right?
Because a lot of my friends are interested about the stock market, option market, but I don't have time all the time. But right now, actually, I have a few times. Yeah, so not an organization, but actually I have a few companies. So yeah, it's a part of organization, but it's not most of the actually share goes to me. So yeah, I'm the sole contributor. Okay, yeah, thank you very much for joining actually the webinar. Actually, if it helps you. Yeah. So let others know also if those guys or anyone interested about the class. Thank you very much. Bye.
Thank you.
Yeah, thanks.
Thank you. It was very informative.